Welcome everyone to Econ to Action, our economic podcast series where we look at how businesses in different market sectors are navigating our economic environment. My name is Josee Farmer. I'm an economic analyst at Experian, and I'll be your host. So far, we've taken a look at a range of market segments that I hope you were all able to check out. But today, I'm especially excited for our episode because we're going to be pulling in some economic data that we've yet to look at on Econ to Action, and we're going to discuss how economic conditions vary across the country. Today, we'll be discussing regional banks with our guest, Matt Simon, client executive for several banks in the Midwest and Northeastern US. Welcome, Matt. Thanks for being here.
Thanks for having me.
Yeah, so Matt, let's get right into it. And can you tell us a little bit about your background and the types of business partners that you work with?
I've spent the past 7.5 years supporting a broad array of financial services partners, ranging from medium to large regional banks to fintechs, small business, mortgage, student lending, you name it, I've worked with them. Many of these lenders have national footprints and serve consumers all across the credit spectrum.
Okay, awesome. So you're very well versed in different aspects of financial services. I know you mentioned you've worked with partners of varying sizes and footprints, and I'm curious how they compare to your regional partners where the economic conditions are a bit more granular than on the national scale. Clearly, different regions in the US are going to have slightly differing economic conditions than others. Take, for example, the Northeast and the Midwest having lower annual inflation than the South and the West, or the lowest unemployment in the country being in the Midwest. So considering these differences and considering your business partners primarily operate in the Northeast and Midwest regions, have regional economic conditions shaped their business strategy in any way?
Well, my business partners all have footprints that range across multiple states and in many instances, multiple regions. So while the regional economic conditions certainly play a part, there's still a lot for them to consider. For example, unemployment is lowest in the Midwest, as you noted, but the UAW strike in the auto industry can increase that financial stress to the region. But then again, the Northeast needs to monitor that situation as well. Strikes affect inventory, inventory affects prices, and also affects the lending opportunities. For community banks and small credit unions, I think the regional conditions play a more outsized role in their strategies. Although what I would say is for my partners that, especially at brick and mortar locations, they take those regional conditions into account when they're conversing with these consumers, try to find common ground, understand those unique challenges that they're dealing with.
Sure. Yeah, that makes sense. And thanks for tying in the auto industry strikes as well. So the October jobs report that was just released last Friday reflected those strikes in the job creation numbers with a pretty significant decline in manufacturing employment. But with those strikes seeming to be reaching an end, we should see some pickup again in coming months. So shifting gears here a bit, in one of our previous conversations, you mentioned how securing deposits has been one of the biggest concerns for your business partners this year, especially following the bank collapses back in March. Our episode on credit unions addressed similar dynamics. So can you elaborate on why this is an issue for regional banks and what sorts of economic conditions led to this, and how, if at all, does this differ for regional banks as compared to credit unions?
The regulatory pressure is certainly there to show a solid balance sheet, especially after those collapses from earlier in the year. But it's not just about optics. As credit quality dips with the rise of delinquency rates, banks need to build their reserves in preparation for an increase in losses. Compounding the issue, and this is true for credit unions too, is the risk of current deposit customers moving their funds to institutions that are offering better interest rates. Inflation, the rise of interest rates, the job market, all of these economic factors are playing a part, and it's a real dance as consumers and the lenders are trying to find a balance.
Absolutely. And as you mentioned, those economic conditions are definitely framing these issues. And now with the talk of rates being higher for longer due to how stubborn inflation has been, these issues may not be relieved for a while. So last question here, Matt. When you look beyond inflation and beyond unemployment, what are your business partners most concerned about?
They're deeply concerned about having blind spots. Buy now, pay later, and other non-traditional lending products are either reported into alternative databases, such as our Clarity file, or not reported at all. And then a more traditional lending industry that's causing blind spot concerns is student lending. The end of the student loan payment holiday creates a lot of uncertainty. Is a downward migration of credit scores coming? And if so, will that impact be delayed by the ramp up program? As an entirely unique economic situation, how predictable will consumer behavior be? Adding again, inflation, unemployment, liquidity concerns, and the interest rate market to this major unknown makes it a constant cause for conversation. I know that my colleagues and I have been doing our best to provide our partners with valuable insights that can help them prepare for the months ahead, but we're truly in uncharted territory.
Yes, most definitely. We are absolutely looking at a shifting environment. And when that's the case, being able to forecast, the coming months, the coming years, that's crucial. We just released our latest quarterly forecast, which for one, show a slowing growth environment. But I will say those growth forecasts have improved every quarter this year. But then for two, our forecasts have inflation coming down to the 2% goal by 2026 in our base case scenario. But of course, 2026 is a ways off, so we are looking at some difficult conditions for the foreseeable future. So I think we are unfortunately coming up on time, but thank you so much for sharing your expertise today, Matt.
Oh, thank you so much for having me today.
Definitely. So now it's time for our monthly economic news for the audience. The US economy grew a staggering 4.9% in Q3 this year, a steep increase from the 2.1% growth in Q2, making this the strongest quarter since Q4 of 2021. Now, once again, consumer spending drove the increase, growing 4% after a 0.8% growth in Q2, a testament to the strength and resilience of consumers. Thanks everyone for tuning into Econ to Action, and please check back in next month for our next episode where we'll explore yet another market. Thanks again. Bye.